Hello and welcome to the QANTM Valuations FAST30 webinar series. Our aim is to share practical perspectives on how IP and other intangible assets can support better transactions, stronger governance, and more defensible regulatory outcomes. Our screen are our next two webinars, together with a Menti poll for future topic suggestions. Please let us know what would be most valuable to you. Today's session is being recorded and we'll share the replay and slides with registrants afterwards. Please submit questions through the Q&A panel as we go. Our topic today is intangible value in the tax spotlight. We will explore why the same commercial events can create several valuation questions, why the accounting number may not be the tax number, and what is needed to produce a valuation that is fit for purpose and capable of withstanding scrutiny. We're joined by Neil Pereira of Pereira Consulting, a corporate international tax, transfer, pricing, and legal specialist, and Tim Heberden, managing principal of valuations at QANTM Valuations, who has specialized in IP and intangible asset valuation for more than 25 years, and is the author of the global guidance note on the valuation of intellectual property rights. Before we start, please respond to the short Menti poll on the next screen and indicate your primary work role. It will help our presenters tailor the discussion to the audience. Thank you, Tim. Over to you.
Thanks, Jack. Yes, just to reiterate, please fill in that poll quickly. I'll start with a short snapshot of the intangible asset landscape, and this provides a backdrop to both the tax and the valuation perspectives. So globally, the bulk of corporate value is contributed by intangible assets, but only 14% of this appears on balance sheets, hence the iceberg image. These boxes depict important categories of intangibles and show how many of these are bundles of different types of intellectual property rights. For instance, a technology consists of patents, copyright, designs, and trade secrets. Now, the days of ignoring the unreported portion of intangibles are over. The tax spotlight shines beneath the surface, demanding visibility of the entire iceberg. And I think that's a good point to hand over to Neil.
Thank you, Tim. Welcome, everyone. We thought it was very timely to run this type of a session, just given the global view that everyone's probably been seeing with things like Pillar 2 and very much a need to look across borders, but also a very significant domestic component of this too. And I think, you know, a key message, I suppose, to set this up is, or two key things. Firstly, you know, yes, intangibles are or can be hard to value, and that's why we have Tim on the call to take us through that. But the other aspect is that, you know, one event, or what we may see as one event or transaction, may actually have several different points requiring different numbers attaching to it. So the sequencing may have different valuation points, and there is a risk of, especially now, of not identifying the asset properly or the intangible properly, and the other is not valuing it at the time of the event, because it becomes much harder to do that later, especially with harder to value intangibles where there's no clear market for them. So that's just setting the scene a little bit. Next slide, please. So what can make it hard to, I suppose, hard to value is identifying the asset in the first place. So in transfer pricing land, in OECD land, you probably hear the phrase that we refer to as to identify the intangible with specificity. So certain tangible assets, obviously easier to identify as long as you know where they are. The harder ones come down to the intangibles. And there is a starting point for these, and the starting point will be your IP register, but then other intangibles are in the process of being developed or various stages of development, etc. So really understanding what you have And some of these, as I mentioned, because they're not on the register, they're not immediately obvious. So the pathway we go through is to look at identifying the intangibles, looking at the legal agreements, performing functional analyses, and then really looking at the whole of the gamut of things that we have, accurately delineating the transactions and then pricing them. So two very important concepts there. I think we can move to the next slide. Yep. Very often we look at legal ownership, and that is quite important, and even more important nowadays. But it is just, well, maybe not just the starting point, but it is a starting point. And we used to very much talk a lot about substance over form. Some jurisdictions place preeminence on the form, which is the legal agreement. A lot of others, OECD, Australia, look at what is the substance behind the legal agreement, but more so nowadays internationally as well. Legal agreements are very important because they do document the intention of the parties, and they're a true record of what's happened. And so tax authorities can overwrite or override the legal agreements if the substance doesn't align with the form. But absent a legal agreement, there's no starting point for you on which to base your proposition. You might have transfer pricing documentation, you might not, but there is no starting point. So it becomes much easier for the tax authority to then come in and place its own view on what it thinks is the transaction, how it should be priced, etc. I suppose the other aspect to this then is the substance, and that focuses on what we refer to as DEMP, development, enhancement, maintenance, protection, and exploitation of the intangible, of the functions. And so this is a very important concept as well, because accurately identifying where these different functions occur, if they don't all occur in the one place, then means that you look at how the returns from intangible assets should then follow and should be priced and should then follow. So it becomes quite a complicated exercise potentially in a multinational group where there are a spread of some of these functions, but the challenge is to really look at them and identify them and to document them as well. So I think we can move on to the next slide. So hard to value intangibles. Broadly speaking, these are ones that there's no comparable necessarily readily apparent for them. There may not be a market for them, and they may be at different stages of development. So they haven't been completed. They're not necessarily copyright or patents or trademarks or things that we might be more familiar with or might be more common. And so, it's not going to be very easy to then set a price or value for these, down the road and worry about it at a later stage. And that's the hindsight problem, where when it gets reviewed, somebody who's reviewing it will have the benefit of that hindsight. And if that the value of that or the revenue from that, the exploitation of that intangible, takes off and is exponential, then it probably becomes easier to attribute a higher value to it ex post. So really taking the time to assess the value contemporaneously, and to look at the potential outcomes and what can be supported and evidenced and defended, I think is key. Otherwise, we open ourselves up to an ex post view of it, which could be potentially significantly different. It's looking at what was known at the time. So this is another sort of angle to take on these things, which are difficult because there is no market. So like property or used equipment, things that are a bit more common to get a valuation of or a price for in the market. Next slide, please. So we just put together a bit of we're calling it a field guide. It's not an exhaustive list, but a little bit of a sheet, which shows, a number of different situations, tax points that arise where evaluation is relevant and needed. Sort of a little bit of a grouping, but more just an awareness. And you can look at this later. I'm not going to go through it exhaustively, but there are different points across the tax regime that require a view to valuation, and Tim could probably tell us whether that valuation means the same thing across these different points. But you may look at tax consolidation and tax base setting of assets, capital gains tax and disposals or deemed disposals, certainly in transfer pricing land where R&D is involved, foreign resident, the new foreign resident CGT rules, business restructures, and even Pillar 2 in the transitional period. So there is a lot to be looked at, and I guess the key questions probably to ask yourself is, or are, what is the tax event that we're going through, identifying what assets or rights are being valued and for what purpose, and is there a standard that's required to be applied to these valuations? Are we talking accounting? Are we talking tax? Are we talking market value? Are we talking something else? So that's critical, and you might have a different view of those for different purposes. So what we thought might be interesting is just to quickly go through a case study. We're not going to, this may not be technically 100% accurate, and we're not going to go through it exhaustively. It's just illustrative, which a lot of people probably would have come across before. From an Australian perspective, we might have a foreign MNC acquire an Australian target. That Australian target may own IP or intangibles. And this is the point, I briefly mentioned before on entry and formation or incorporation into the tax consolidated group. The Australian tax rules require a resetting of the underlying tax costs of the assets. That ACA process goes in proportion to market value. So you do need to have a view of market value. At the same time, you might have accounting consolidation and things like that, which will require a purchase price allocation, a PPA. And sometimes the shorthand may be to think, hey, we can use the PPA for the purposes of tax consolidation and apply the ACA that way. And potentially that could work for cash and those type of assets, for tangible assets. But when you get to the intangibles and goodwill, the PPA may not be sufficient and may apply its accounting principles, so may be quite different to what we need from a tax perspective. Next slide, please. So as we progress in that transaction, we may see the Australian target's been acquired. We might have set the ACA. And then in this supply chain, you might have different things going on. There may have been a royalty in play, inbound and outbound, if it was an Australian MNC. And you might have had Australian management who might have been the founders if it's an Aussie company. And so where does that value in that supply chain continue to be exercised? Does that continue to be in Australia, or is there a gradual exit of those founders? And how does that affect both the inbound and outbound royalty? And also, if they are bundled goods, then is there potentially an embedded royalty that needs to be apportioned? And PepsiCo case is quite important here, but important to also note that was narrow and fact specific. And so the ATO's response, I think, is still emphasizes the need to identify, the totality of the arrangements on the face of it, on the facts, and look at what's required. So that's just a quick snapshot post-acquisition, and then we look at potentially the another leg of it being, well, okay, if we had IP in Australia, that now may need to be, the group may want that moved somewhere else where they hold all their IP. And so that could be another valuation point. You've set the cost base at some stage. Now you're transferring the asset offshore. What is the totality of that? Does that intangible comprise, and what is values attributed to it to work out the CGT on that? So that's critical. And then also looking at the ATO's PCG will be very important there. So I'll leave that slide as it is. So you can see in the next two slides, we're just really calling out, you know, one transaction, I suppose several steps in that transaction. The group may see it as one pathway, but you know, we've just dotted there. There could be a number of different valuation points. It's a genuine commercial transaction, that's fine, but there are several different valuation points and questions, again, to be looked at. A minor point that I've made there just on Globe and Pillar 2, which could be relevant during the transitional period in relation to what step up is available there. So that's another point that may also, for assets that have moved in the transitional period, before the start of the transitional year, looking at the valuation of which jurisdiction. The next slide just highlights, you know, in that, going back to the field guide, we've just highlighted for convenience what the valuation points could be. I'll very quickly go through this one because I'm conscious I want to hand back to Tim to go through his slides. Another one is just looking at a headquarter migration of an Australian business where that starts to go international. And this also raises a number of valuation points. It also raises the ATO's PCG to be looked at. You can sort of look at that a bit more in your leisure, but in the next slide, we sort of again point to some of those valuation trigger points as we flow through that. So you can sort of see we try to just look at it in the context of what kind of transaction do we have, and maybe the field guide could help identify some of the common or key valuation points to be looked at. On the next slide, I've just quickly mentioned a couple of areas worth looking at in terms of where other points where valuation is relevant to sort of tax outcomes that are probably less front of mind. And then just highlighting in the next slide where you have offshore migrations, IP transfers. The ATO is also set out in PCG 2024-1, looking at how you risk weight those scenarios from, you know, traffic light type system, and really weighing up what's happened, where the DEMPI is, and that also comes back to really this identification theme. And I might just quickly touch on this. So we've seen disputes internationally on transfer pricing and intangibles and valuation. And I've just highlighted 3 cases, and I'll just quickly call out what I think is relevant in each one. In PepsiCo, I think it was characterization first in relation to the transaction and the assets, and what was the price paid for what. And is there a royalty at all in those circumstances, and how you apportion? Coca-Cola, which is US, was really, you know, the method selection there sets out how you go about the valuation and the outcome. So what framework produces what number? Medtronic was comparability. So a single point of failure, a single comparable arrangement, third-party arrangement, which was end up being very kind of narrow to put everything on that one. So in summary, you know, we've seen probably a number of different valuation points across the spectrum of a transaction. And we've also seen different methods or numbers put to the same asset, which none of which may give you the actual market value. So the PPA, the ACA, arm's length value for transfer pricing purposes may not be what you actually need to establish market value. So value it properly using a specialist valuation, value it contemporaneously at the time of the transaction, and then take it forward from there. Over to you, Tim. Thank you.
Thanks, Neil. And for those wanting more time to digest the content, you'll be sent a link to the recording. Here's a snapshot of the landscape for tax valuations. The main point being that valuers can't just roll out the same old template for tax valuations. Of the international standards shown on screen, International Valuation Standards is the preeminent reference point, whatever the purpose of valuations. Now, the top row identifies other essential reference points when conducting valuations for Australian tax compliance, and the grey shaded boxes relate to Singapore. In both jurisdictions, the tax authorities point to IVS, and there is a loop as IVS explicitly states that to be IVS compliant, it's necessary to adhere to jurisdiction-specific and purpose-specific legal, statutory, and regulatory requirements. Due to the importance of IVS, let's have a quick tour of what it covers. This is basically the full valuation process. Valuation discussions often focus on methodology, but the general standards remind us that this is just a single part of the process. In the asset-specific standards, it's IVS 210, which focuses on intangible assets. This covers broad categories of intangibles, but it does not drill into the underlying rights shown in our iceberg. The RICS guidance on the valuation of intellectual property rights is more granular, and it sits beneath IVS 210. So where commissioning, conducting, or reviewing a valuation, I urge you to consult IVS. For example, familiarity with IVS 102, its basis of value, and local tax requirements will avoid the first pitfall that I'll cover. Valuers should resist the urge to start number crunching before clarifying the basis of value, which could be market value, fair value, investment value, equitable value, liquidation value, and so on. This is a fundamental step, as different bases of value may require different inputs and can yield significantly different values. Here are key components of basis of market value, which is required for Australian tax purposes, and it's a situation where Australia's 1907 Spencer v. Commonwealth case is aligned with IVS. So we need an arm's length transaction, the buyer and the seller both acting knowledgeably, prudently, and without compulsion, proper, not rushed marketing, and highest and best use of the asset. In contrast, Singapore's Inland Revenue's guidance on IP valuation refers to the open market price. We won't go into any intricacies on potential differences today. The need for a clear and specific description of the subject asset should also be done before starting the number crunching. Not doing so is an obvious pitfall, but I've often read 50-page valuation reports and been none the wiser of the specific rights included in the subject technology, brand, or data asset. Once again, think back to the iceberg. All of the guidances stress the need for clarity of asset description, and the RICS guideline points out that the rights to an asset can vary between jurisdiction and between class of product. And with regard to the transfer pricing terminology, it's a bit sad that specificity has become one of my most used words. And here's why. Here's an example of the potential impact of a lack of specificity blunder. In jurisdiction A, our asset that we're valuing is called new tech, and it consists of patents, designs, copyright, and confidential information. In the second market, The subject asset has the same commercial name, but when the client was cash-strapped, it had allowed the patents to lapse. So in market B, new tech is a lesser asset, probably with reduced earnings, shorter economic life, and lower value. Without a granular description of the subject asset and segmented analysis, the valuation will deviate from commercial reality. And although this bundle of rights is aligned with commercial practice, the value might need to be apportioned by or to constituent rights if they're subject to different tax amortization rules. And this is probably best done as a follow-up step. Incomplete identification of assets is another pitfall. An example of where in a multinational tech company signed off a PPA, and this only attributed a small share of value to technology. Should have been obvious on suspicious on face value, but it was only a couple of years later when IP was going to be moved from Australia to align with the group's operating structure that it became clear that a defensible market valuation on exit would trigger CGT due to the low tax base. At this stage, we were commissioned to do a revaluation, and the IP discovery process revealed that a data platform was central to competitive advantage. Fortunately, our assessment identified compelling internal and market evidence supporting the impact of the data on revenue and operating efficiencies. So its value increased the cost base when it was stripped out from goodwill, as did an uplift in technology value. But this fix wasted time and incurred additional fees. It also increased the tax risk due to the need for the second valuation to explain the differences to the PPA. So the moral of the story, before commissioning a PPA, ensure that you consider commercial and tax requirements. Get it right first time. There is a follow-up in the orange box that it can be important once again to apportion value or to conduct the valuation by jurisdiction and possibly also then to apportion value to specific rights. There's a different spin on the completeness of asset identification. Let's start by assuming that a valuer is asked for an opinion on the market value of a software platform for a related party assignment from an Australian company. For a standalone software asset, the subject asset is the IP existing at the valuation date. The commercial utility of this existing platform will decline, hence the decay curve illustrated on screen. However, the platform itself in its various incarnations might maintain the same earnings potential, but this will increasingly be generated by the code that didn't exist at the valuation date. The disconnect arises when the subject of a valuation report is the current generation platform, but a tax authority argues that either the transaction included a broader asset pool or that the Australian company maintains economic ownership in the next generation platform. So preventing this pitfall, it's really essential that valuation and tax practitioners communicate and clarify the nature of the transaction, and ensuring that each piece of work is clearly briefed and consistently briefed. So at last, we get onto valuation approaches and methods, but it's going to be a short visit. In my experience, valuation methods are pretty well understood. The pitfalls lie in applying them in a way that reflects the complexity of the subject assets. So the three different valuation approaches on the left-hand side, and let's touch on them. use of the market approach is limited for intangibles that are not homogeneous, and in the most part, they're not being liquid markets for them. Replacement cost under the cost approach is an appropriate method for valuing assets without a legal barrier to replication, such as some software. And you'll see IVS 103 comments on where it's appropriate. For unique intangibles, where reasonable forecasts of earnings can be made, the income approach is generally the most appropriate, using one of the methods listed underneath. IVS refers to reducing the weight placed on this approach if there's significant uncertainty regarding the asset's future earnings, but you'll note that the OECD favors the use of probability-weighted outcomes for hard-to-value intangibles. Perhaps the most important point is also listed under IVS that more than one approach or method is often appropriate where one is unlikely to produce a reliable conclusion. And when you consider the economics of IP assets, it's their upside potential that excites founders and investors, scalability and nonlinear returns. But in this game, there are snakes as well as ladders, and misdiagnosis of an IP asset can lead to alarming differences in valuation, assumptions, and findings. That's why at Quantum, we conduct what we call full spectrum assessments or gradings of IP assets, and assessments that link directly to valuation assumptions. Here's a practical example of the importance of understanding the correct characteristics of the subject IP and linking these to the findings of valuation inputs. I'm sure that you've seen relief from royalty patent valuations or trademark ones which select a median royalty or refer to the interquartile range. Let's step back and think about what this range looks like in the context of the licensing royalty base that it's selected from. So we've got different points on that portion of the curve, and that's the snag. The database doesn't represent the entire population of patents. It includes both the long tail, patents which aren't licensed or aren't licensable, and it also excludes owner-used IP, which is often at the top end. So this raises the questions: why restrict our analysis or our conclusion on an appropriate royalty to a subset of the population? Why the median? Why not zero? Why disregard a high 15% as an outlier? And some takeaway points again in the orange box. The key message is that selecting a royalty rate without reference to the IP assessment can be a chronic defect in evaluation. And this is well articulated by this real-life extract from a cross-examination in a case I was involved in. And the QC reference to different countries, different millennia, and different businesses in the so-called comparables is in itself a punch in the face. However, this was swiftly followed by another blow referring to the lack of a cross-check of that analysis. Fortunately, I was on the other side of that discussion. And here's how we ground our evaluations of an intangible asset: discovery process, value mapping, and 360-degree grading of core assets. These are not isolated studies. The work steps at the left-hand side of this diagram are the foundation of the valuation, and they're connected to our choice of methodology, our valuation inputs, and our cross-checks. And in the report, it's ultimately the building blocks and connections within the valuation process that provide a compelling commercial narrative and the cross-checks of the full process and the findings. Before you get to the tax compliance phase, valuations can be an effective tax planning tool. Here are 3 examples that you can review at your leisure, but in short. The first is a situation where valuation modeling identified payment structuring that reduced tax risk and made sense at both ends of a related party transaction. The second is where pre-acquisition modeling of value allocation between assets informed tax or amortization benefits, and this in turn helped the investment bank determine a negotiating range. And the third is where post-acquisition analysis of a rich IP portfolio identified commercialization opportunities which informed the structuring of the IP. So pulling this together, completing the picture, I think the obvious checklist point for companies are to be aware of tax triggers, get on the front foot with your intangible asset management systems, and select valuers carefully. It's also important to realize that this isn't just a tax compliance thing. The same metrics are needed for effective management of these essential corporate assets. For valuers, be familiar with the standards and know what you don't know. So I think that's a good point to hand back to Jack. Thank you.
Thank you, Neil, and thank you, Tim. And well done for compacting a substantial amount of content in a very short period of time. True to the FAST30 name. So we'll now move on to Q&A. If you haven't done so already, please add your question to the panel. We will address as many as time allows. Okay, perhaps I could begin with a practical question for the both of you while we wait for more to come in. When a business is planning a transaction involving intangibles, what is the earliest warning sign that a purpose-built tax valuation may be needed rather than relying on existing accounting valuation?
You want to go in first, Neil?
Yeah, I think it's an interesting one, right? Because you don't know what's going to happen to the business. If you're talking about business building, then you potentially have to have a little bit of a view as to what's the what's the eventuality that or the goal. I think if there's an IPO or a trade sale or some kind of event like that, there's a certain view as to what the assets might be. But then if you're looking at offshore expansion or headquarter migration, or we want to get into the US and make that our headquarters, or business goes gangbusters, then there are some different considerations. So I think it's really it's not putting the cart before the horse. Sometimes it's really understanding, well, what are we driving towards in this business? What is the end goal? And that'll help, I think, with some of those points. But Tim might have a view on that too.
Yeah, the thing I'd say, Jack, is that it's often very useful, whatever the transaction or whatever strategic shift is being considered, to use a stepped approach to valuation, because often, very high level indicative valuations can really inform on decision making and what's smarter than an alternative. And in the opposite to that, we often come in after a transaction and the client really doesn't have a good understanding of the different intangibles that were driving its value before or after a transaction. So, there it's very much maybe a gut feel has led to something, without having all of the information, without being able to do different scenarios, without having to work out where you need to dig deeper and get to understand the assets more clearly.
That's brilliant. Great answers. Thank you, Tim. Thank you, Neil. Just reminding everyone that our next sessions are building a valuable IP portfolio in clean tech on 13 October with the FPA Penn Attorney team, and our M&A and value creation prices not value on 1 December with Richard Stewart, OAM. Very exciting sessions are coming. But also, please feel free to suggest any other topics that you're interested in hearing us speak about. You could use the Minty poll QR code right there on the screen. As mentioned in the outset, we will share the recording and slides with registrants. So if a question occurs to you afterwards, please reply to the webinar email or contact the QANTM Valuations team. Okay, let's see. What is the ATO expectation and how often that intangibles are to be valued and recognized in the balance sheet?
I think that's a couple of different questions there, but I don't know if there's a ATO expectation, necessarily that these intangibles are valued absent, the relevant kind of trigger point for a transaction. Maybe Tim's got a view from a financial statement perspective, if that's where that question is getting at.
Well, I was going to say the second part of that question is, even if the valuation is required for tax compliance, that doesn't mean that the asset value will end up on the balance sheet just because of the differences in financial reporting requirements and tax reporting.
Great. We have another question. How do you approach valuing the goodwill of business involving intangible assets?
I guess I'll just jump in from a valuation perspective, and it's quite an important point. In Australia, there's a lot of case law on goodwill and the reference to legal goodwill, and that can require, again, more detailed analysis and can differ to what from financial reporting is just the kind of residual goodwill. So yes, goodwill is always valued as a residual asset relative to the overall enterprise value. But one has to go into more detail for tax reporting to identify the sources of goodwill and make sure that you're not attributing value to goodwill that inheres in another asset, for instance. But Neil, you might want to give more tax comments.
No, I think you're right on target with that one, Tim. I think probably the key thing is also, when you're looking at it, what is, I sort of go back to the point around maybe the PPA and what is sort of residual goodwill and some of the slides that you had, and what should or can be split out from that into, more specific intangible assets.
Right. We have one last question that came through in the end. What are other common tax implications other than the transfer pricing mentioned in the session?
Well, there's usually probably a question of disposal and CGT that kind of is a large aspect to it. The tax rules have market value substitution rules in there as well. So both from a tax and a TP perspective, potentially, is that transaction occurring at arm's length? Is that the market value of the asset when the parties aren't dealing at arm's length, etc.? Can the market value be substituted for that asset? It could also come about where you've got, as I mentioned, non-resident CGT, and you look at what is the composition of the underlying business from the perspective of land assets versus non-land assets or intangibles for that matter. What's the weighting? Is it 50% more or less than 50%? So you're looking at it from a tangible, intangible, or non-land perspective. So that's where I see it come up time and time again, is in a kind of a disposal context. And then we've seen, the recent federal budget talk about changes to the 50% CGT discount, and this and other areas, but establishing what is the relevant cost base of the asset going forward, and that may require quite a specialized valuation as well, and that's coming up, next year as well.
And perhaps one to add on is, the tax amortization. So that can vary by jurisdiction. So it's Section 19B in Singapore or Australia. It's also a thing, and there'd be different assets in different jurisdictions that qualify for tax amortization, and often different periods or amortization rates.
Excellent. And thanks everyone for staying for this extended Q&A session. There is one more question if the presenters can fit this in. What are the key points to consider when doing transfer pricing valuation for tax purposes?
I would, if I jump in first, I'd just say it's being very clear on, what jurisdictions are impacted and what the requirements are within each one of those restrictions. So, Neil and I, working together in the past, have had issues where US transfer pricing valuations have been done with the presumption that that will be fit for purpose in Australia, and very different lens, very different requirements have been carried on. So it's that same sort of basis of value standards and guidelines and so on. Neil, did you want to add to that?
No, exactly right. In some cases, transfer pricing approaches will overlap with valuation methodology, and I think we saw in that first part of Tim's slide where there's comparables, you could get to the similar point. Royalty ranges, interquartile ranges. You've got a basis on which to compare the asset, the value, the royalties. That's where you can get more kind of overlap with approaches. But as you sort of start to get away from that, it probably becomes harder to just apply a transfer pricing approach to, obtain a valuation, and that'll differ by jurisdiction, and differ also whether you're applying OECD standards or from a transfer pricing perspective, non-OECD US requirements, where it could be quite common for transfer pricing specialists to perform valuations. So, and as Tim said, we've experienced this, and you have to then kind of align on what is the right outcome, or right set of rules, basically, that you're aligning to.
And then sorry, Jack, the last thing, one's kind of got two valuations, which can be fine as long as there's a bridge and you explain why there's a difference in the findings for jurisdiction A as opposed to jurisdiction B.
It's a very fair point. Thank you, Tim. Thank you, Neil. And to everyone who joined us today, see you at the next FAST30 webinar. Thank you.
Thank you.